Welcome to Stock Talk with Mike. I'm going to talk to you today about Sea Limited. They just reported earnings a few days ago, and they absolutely knocked the cover off the ball as far as revenues. We just saw some massive, explosive revenue growth. Earnings were not so hot as far as they operating in a big loss, but again, just massive revenue growth. And they also gave some really good guidance with continued growth in all aspects of their business, really. Their e-commerce platform, Shopee, and their mobile payments as well, but then Sea Money. And then also, obviously, their continued massive growth in mobile gaming entertainment. And with their big hit, obviously, that's still a key contributor to their revenues to date, and that is Free Fire. So if you like this kind of video, please consider subscribing to the channel. It'd be great also if you like this video. All right, so just covering my holdings of Sea Limited before we get into this Q2 earnings report. I hold Sea in my growth portfolio. It's the fourth largest position in the growth portfolio and actually my fifth largest position overall. I also have, what doesn't show up here, Amazon. I actually you could obviously put Amazon in a growth portfolio, but for me, with the larger market cap, I made the decision to put Amazon, I allocate that within my staples value portfolio, believe it or not. So that's either staples or value. Obviously, Amazon also trades a bit rich and has some big growth, but I look at it as more of a staple, safe play, given its huge market cap and stable business model. So looking at my holdings of Sea, I was a bit late to the party with Sea Limited. Oops, go back here. Let's see. There we go. I was a bit late to the party of getting into Sea Limited, and I thought it was, you know, a lot of its upside had already potentially happened. I knew about the company for quite a while. I was waiting for a pullback. I finally pulled the trigger on August 10th of 2020 at $120.50 a share, limped in. And since then, in basically 1 year exactly, it's up 164%. So that's why, you know, you hold some of these explosive growth stocks, they can really make up for any losses in some other stocks, and really provide some massive upside that a balanced value portfolio can't really hold up to, right? But again, these stocks are often, like Sea Limited, not being profitable. They're very hard to evaluate, and it means much larger price fluctuations. So you have to have a little bit of thick skin and know when to be adding and whatnot as well. So I've also been accumulating some shares here in 2021. I added some more back in March at $216.25 a share, some more at $213.35 when we were seeing that bit of a dip in some of the high growth stocks. And I bought some more even later in March. So all in March there, another 5 shares at $205.66 a share. And those holdings, what was that, like 4 months ago? And those holdings are all up 47 to 55% in short order since, you know, since March. So it's done really well. Sea has been on a really good run. And this is obviously, as I mentioned, a core holding for me, being my fifth largest position. I have a lot of e-commerce plays, and I like some international exposure to the space because I think that's where some of this big upside growth is still playing out, as we see here with Sea Limited. So again, they reported earnings on August 17th, and some of these numbers are just ridiculous, all right? Like, so their total GAAP revenue was $2.3 billion, and that was up 158.6%. So this is a company that's been growing like a weed for 5 years, had tremendous stock performance, and their gross profit was $930.9 million, and that was up 363.5% year over year. So massive improvements in their gross profit. So it leads me to believe there's potential here to work with as far as better margins. But a bit of a bummer here, the total adjusted EBITDA was negative $24.1 million, and that was compared to plus $7.7 million for the second quarter of 2020. So a much bigger loss. and they were actually profitable a year ago there. So really, that's a bit of a drawback with C Limited, is that they are spending a lot of money. But if you look at their SEC filing, they've really doubled down on R&D and on marketing spend as well. And so far it's paying off as far as acquiring customers, retaining customers, and growing that top line. And I'm okay with that with a company that is in the growth phase. I think it is important that they invest in their growth, expand to new markets, that they diversify their entertainment space away from just Free Fire, which has been such a profitable game for them. It's got to be one of the most successful mobile games of all time. So I'm okay with that for now. But even as we get into, I think analysts are expecting them to become profitable here in the next couple of years. So yeah, well, either that spending is going to have to cut back, or that revenue is going to have to just continue to explode. While the expenses sort of stay consistent. I just want to go to the chart for a bit. So I mentioned that growth they've had and already seemed expensive. Well, first you're looking at earnings. So it was trading at, you know, around 295 a share or so before earnings, then shot up to around 318, traded up into the 320s the last day or so, and settled in here at $318 a share. So we've seen a good upside move of 5 to 7% or so since earnings earlier in the week. But if we move this chart out a little bit, you can see it's been kind of just a steady climb up. There has been some selling off, mostly during larger market sell-offs that we've seen in C Limited. And those have all been buying opportunities. Definitely, if you watch or read the forums and whatnot, there's definitely the naysayers that say that C Limited is massively overvalued. But I've heard that the whole time C Limit's been a publicly traded company. And some of that's probably gotten my ear and stopped me from getting invested in C Limited earlier. And, you know, that was a huge mistake. You know, I was really late to the party, even though I've done really well with C Limited. You look here at the 5-year chart, and you're looking at a company, that was, you know, 15 bucks a share 5 years ago. That's traded up to $300 a share here. So just massive growth. Actually, I haven't even been public 5 years, but since, you know, 2017, 2018 there. So huge move in C Limited. You've seen a stock run up 500% or so before I even got into it. Since I've been in, seen another 150% increase or so. I'm just going to scan through their investor presentation and just comment on a few of the highlights from their Q2. So as I mentioned revenue already. Also their digital entertainment space bookings up 65% year over year to 1.2 billion. E-commerce gap revenue growth up 161% year over year. So e-commerce is growing exceptionally fast and really contributed to this growth. So that's at 1.2 billion as well. So digital entertainment and their e-commerce are their two largest components of their business. So looking here again at their digital entertainment, so we're really talking about Free Fire and their mobile gaming platform. Is up. Quarterly active users up 45%. So more people are engaging. So that's incredible, because I think people thought that maybe Free Fire had peaked, but we've just seen actually an acceleration of that growth. Look at Q2 2021, even compared to Q1 2021. It was actually we actually saw an acceleration of that growth there. So really incredible, and well up from the Q2 2020 number. Quarterly paying users is up even more, up 85%. So more people are paying to play, and that's up to 92.2 million in Q2 of 2021. E-commerce, so Shopee, they have an online e-commerce platform. And again, this is in Southeast Asia, in Singapore. And gross orders up 127% year over year, and gross merchandise value up 88% year over year. So that's the total value of the products they're selling, up to $15 billion worth of product. So you're just seeing these triple-digit growth rates that just are showing no signs of decelerating. And it's just incredible, the fact that they're getting tougher and tougher comps, and they're still just blowing the cover off the ball. It's just incredible. But that's what happens when you have under penetration in a market. It can lead to this really outsized growth. Digital financial services. So they offer a mobile wallet through, I think it's called through C-Money, their mobile wallet. And total payment volume in Q2 of 2021 was 4.1 billion. And that was up 150% compared to Q2 of 2020. So massive growth in adoption of their mobile wallet. And again, I like that they're including the paying users part in here, because that's important. Quarterly paying users for the mobile wallet was up to 32.7 million in Q2, and that was up 109% compared to Q2 of 2020. So they're just seeing massive adoption and massive increases in revenue from all these elements of their business. It's really incredible. Gross profit, I mentioned this before, up 364% year over year to $931 million in Q2 of 2021. Non-GAAP EBITDA, so earnings before interest, tax, deductions, and amortization, was down was negative 24.1 million, so way down. I did mention that looking through their SEC filing, they really ramped up their research and development spending, their marketing spending, as trying to broaden out some of these platforms and to continue their growth. So again, when a company is growing at this rate and stealing market share, I'm okay with them spending that money, especially when they have cash on the balance sheet, which I'll show as well. C Limited does. So yeah, they are operating at a fairly hefty net loss. Q2 of 2021, net loss of negative 433.7 million. So definitely something to keep an eye on and a knock against C Limited. And you know, that makes it a difficult company to evaluate, right? But these kind of disruptive companies that are growing quickly like this and spending on research are the companies that ultimately, in my opinion, succeed and sort of take over, as they have the ability to expand into these other markets and develop new revenue streams that people don't even have on their radar yet, right? And I think that's what we'll see with C Limited, is they find new optionality and new revenue streams. And hopefully they can turn on that spigot. We're seeing that the gross profit increased substantially. So that makes me confident. That's the number I'm going to watch closely too, is see how that gross profit increases, because I think that'll kind of give us an indication of future profitability potential for C. They can always cut down on some of their marketing spend and focus more on frugality later as they're more of a maturing company. Cash on the balance sheet, or cash and cash equivalents, is down a little bit, but they still have $5.6 billion of cash are sitting on in Q2 of 2021. And here's the kicker. So again, they reported phenomenal revenues, but even better, they raised their full year guidance on a couple metrics here. Digital entertainment bookings, so again, this is their mobile gaming, full year 2021 guidance of 4.5 billion to 4.7 billion. That's the range they're forecasting, and that's 44.4% year-over-year growth. And the previous guidance they had given was for 4.3 to 4.5 billion. On the e-commerce side, they're forecasting, they're giving guidance of GAAP revenue of 4.7 billion to 4.9 billion dollars. So again, the GAAP revenue e-commerce and the bookings through their digital entertainment mobile gaming are very similar. And that's 121.5% year-over-year growth they're expecting on the full year. And the previous guidance was 4.5 to 4.7 billion. So it's nice seeing a pretty nice, these are billions of dollars, right? So seeing a pretty significant increase in guidance up $200 million on each of these alone. So that's, $400 million combined. And if there are other components of their business are still also expected to grow, I expect some big numbers in Q3 and Q4 for C Limited. All right. Just looking at some other things here, C. So again, the market cap right now, around 162 billion now. It's just incredible. We've seen such massive growth. It's last year now it's up 130%. Last 5 years or so, up several 100%, as I mentioned. So just incredible. And you can see these revenue numbers. So obviously big revenue growth on the quarter and in 2021. But you look, they have a long history of that. 2016 revenues were 345 million. 2017, 414. That doubled or more than doubled in 2018 to 827 million. Right? There's no way you can keep up this 100% growth, right? So that was 827. Then in 2019, 2.18 billion. There's an acceleration. Where can they go from there? 2.18 billion in revenue, spending money like crazy. Oh man, I bet you revenue is going to slow. Oh, 4.38 billion, more than doubled. Where do they go from there? 8.77 billion, more than doubled again, expected here in 2021. 2022, we're expecting $13 billion in revenue. Like, it's incredible. This is an executing company, one that I'm very excited about. I mean, it doesn't get better than this as far as a high growth company. In 2021, earnings per share expected on the full year up 12.33%, with sales up 100% or revenue up. 2022 earnings per share are expected to get above break even at earnings per share of 7 cents, and revenue growth up 48%. I bet they'll beat that based on what we've seen in the past. 2023 analyst expectation numbers sees their earnings per share up substantially to over $3 a share, $3.09 a share, which would give them still, a PE of in the hundreds at 102.98. So still, again, that would be a high valuation, and we're looking 2 years out here, right? So it does trade expensive, but you are paying for just incredible growth with C. It's very difficult to evaluate a company like this on standard metrics of obviously EPS when they don't have earnings. It could be more difficult. And I look at, some of these high growth companies, I'll look at their price to sales ratio, but even that can be a pretty tough metric alone. With these high growth companies that I really like the business model and what they're doing, I'll usually weight in whatever the valuation is. And if it goes down, buy some more because it can be highly volatile. But a company like C can be overvalued or expensive for years, maybe even a decade or more, right? Like we saw with Amazon and a number of other companies. Some of these high growth companies with phenomenal performance over long periods of time always trade expensive. I highly suspect the C Limited is never going to trade cheap, or at least not, for the next decade or more. And it's been publicly traded for a few years now, has never traded cheap, and has been a phenomenal performer. So I don't think that a reason alone not to be invested. So going on here, looking at 13Fs, so hedge funds and money managers that hold over $100 million in assets are required to report quarterly on their buys and sells to companies they're holding. And just recently, 13Fs were filed for Q2. So we're seeing a bit of some updates here as far as 13F filings. And a lot of funds are holding C Limited. It's in the top 10 of 84 funds. That's down from 87 the quarter prior, but pretty similar. The funds holding it altogether are actually up on the quarter to 713. That's up from 622. And percent ownership sitting around 72% held by institutions, so high institutional ownership. And new positions and increased positions is up substantially higher than close or reduced positions. So that's really good to see as well. So everything looks really good there. As far as analyst price targets, the current consensus, there's 13 analysts rating the stock or covering the stock currently. 12 are a buy, 1 are a hold. But again, I think these analysts have a hard time keeping up. Their price target right now on average is $325.67, which is only a $2.22% upside from here for the next 12 months. But again, this is a company that's been on a strong run recently. And obviously, what often you see with these companies that have buy ratings on these stocks is they push through their targets. Analysts will catch up and raise their target out again. So we'll see that with C, I'm sure. And you see like back in August of 2020, the average price target was under $100. So this is one of those stocks that analysts have just been constantly upping their price target, trying to keep up here. Yeah, something else I like to look at. So again, I've been invested in C Limited for a year now. It's been a great investment. I wish I got in earlier. Again, I probably let the noise creep into my head that it trades expensive, waiting for, I think I followed it for a couple of years actually even, waiting for an opportunity where I thought valuation looked more attractive, I guess, or maybe even looking for like a 20% correction or sell off in the stock. I never saw it. It just kept going up. And one day, maybe there was a bit of a pullback or whatever, but I finally pulled the trigger on C, and I'm glad I did. But it just reminds me that when I have high conviction on a company, regardless of that valuation, if it's a high growth stock like that, I think my preference, and I try and convince myself this all the time, is to get in with a small position, wait in, and if it comes in more, to buy more. But if it keeps going up, I'm glad I'm already participating in the company, in the stock, holding it for the long term. Again, there's a time and place for company valuation. Valuation is always important to some extent, but on a company like C Limited, you can't use those traditional metrics. So I think you just have to have a good balance in your portfolio of some of these high growth stocks that can really, I think, provide some of those upside returns in the long run. And there's a history of that. You look at companies like Amazon, Nvidia. I mean, these companies never trade cheap, but have provided just monster returns and make up for so many losers in your portfolio and cause you to just crush S&P 500 returns over any decent length of time. But that being said, I think there is a place to have a percentage allocation in your portfolio, depending on your risk tolerance, to have more value stocks, dividend stocks, just to provide you with that less volatility and more of that steady eddy over the short, medium, and long term. So anyways, that's about all I got for you today. Thank you so much for watching, and happy investing.